A financial civil war has begun inside the United States government. This is objective analysis, not financial advice. The U.S. Treasury now spends more on interest payments than on its entire military. To fund this, they are performing the Federal Reserve's job, a dangerous, unprecedented power grab. The Treasury is flooding the economy with cash through massive spending, while the Fed is actively draining cash from the system. They are working against each other. This is the liquidity war, and it creates one critical, ticking time bomb for your wealth. U.S. bank reserves are currently at $2.96 trillion. If they fall below $2.8 trillion, it triggers a system-wide red alert. The question is no longer if this conflict will cause a crisis, but how you will position your assets to survive it. This isn't just a policy dispute. This is a fundamental breach. The sacred wall between the Treasury and the Fed is crumbling. The Treasury is now directly manipulating the yield curve, the bedrock of all borrowing costs. When the entity that needs to borrow the most money also starts controlling the price of that money, the system has lost its anchor. This is no longer a market, it's a controlled demolition. This is the core divergence. Treasury liquidity is pumping up the real economy. GDP estimates are surging. But Fed liquidity is being sucked out of the stock market. This creates a dangerous schism. The real economy feels inflated, while the markets are being starved. This is why your stock portfolio can be crashing, while the price of everything you buy remains painfully high. And the fuse on this entire setup is the bank reserve level. When the Fed's QT vacuum sucks those reserves below $2.8 trillion, the financial system's circuit breaker blows. It starts with a spike in short-term lending rates, then credit seizes up, liquidity evaporates, and finally, the everything bubble in stocks and bonds faces its moment of truth. This is the second-order effect the mainstream isn't telling you about. So, what is the prudent response? You adopt a barbell strategy. One end is fortified for safety. The other is poised for asymmetric upside. On the safety end, you need a non-correlated anchor, an asset that moves independently of this institutional war. The Treasury's liquidity flooding the real economy creates powerful, sustained pressure for hard assets. This is gold's strategic edge. It is not someone else's liability. It is immune to the Fed's QT. On the other end, you avoid equities that are facing the direct pressure of the Fed's liquidity drain. Instead, you look to real economy assets, true hard assets that are buoyed by the Treasury's fiscal spending. Your protocol is simple. First, watch the bank reserve number like a hawk. Second, if it cracks the $2.8 trillion floor, immediately reduce exposure to speculative risk. And third, capitalize on this divergence by allocating to hard, non-correlated assets. This isn't speculation. This is strategic defense. This liquidity war reveals one brutal truth. The institutions you were told were pillars of stability are now combatants. In this new reality, true financial independence doesn't mean beating the system. It means building a fortress outside of it. True sovereignty means owning assets that no central bank can dilute and no Treasury Department can inflate away. Stay prudent, stay sovereign.